In this financial evaluation modeling training, we are going to start with module 1, which is all about introduction to financial modeling. It has three sections. Section 1, what is financial modeling? In section 2, we'll discuss very briefly the types of financial models. And then in section 3, we'll discuss a little bit about planning and designing a good financial model. Let's get started with section 1.1. What is financial modeling? Financial modeling is projecting a company's financial statements in a way so as to understand the future of financial fundamentals of the company. It is a step-by-step approach to forecasting the results of the company, which basically is the income statement, the balance sheet, and the cash flow statement. Usually, companies' management only provides financials of time periods that is historical. However, for better understanding the company's future, analysts project the financials using financial modeling. Financial modeling is not just a spreadsheet, it differs from a spreadsheet. So we're going to use the next section to tell you what differentiates a financial model from an ordinary spreadsheet. Number 1, a financial model is more structured than a spreadsheet. It contains a set of variable assumptions, which includes the inputs, the outputs, the calculations, and scenarios. It also includes a set of standard financial forecasts, such as profit and loss statements, a balance sheet, and a cash flow, which are based on those assumptions. Let's look at a typical financial model that we've developed for a private company. In this model, for a company called OJ Limited, we have under this assumptions tab various assumptions, input assumptions for the revenue. We have assumptions for the direct costs, and we have assumptions for other company expenses. And all these assumptions have a role to play in the results of the company, in its balance sheet, in its income statements, in its cash flow statements, and even the valuation of the company. All of it are based on the assumptions that are being created in this financial model. Number 2, it is flexible and dynamic. A financial model contains inputs that, when changed, impact the calculations and therefore the results. A financial model has inbuilt flexibility to display different outcomes or final calculations based on changing a few key inputs. Let's look at a typical financial model that we've developed for a private company. In this model, for a company called OJ Limited, we have a worst case estimate here, a base case estimate here, and a best case estimate here. All of these estimates have various inputs that have been predefined. For example, the average price per card under the worst case scenario is 550 naira. In base case, it's 600 naira, and in the best case, it is 650 naira. So, if you choose, for example, the worst case scenario, the price changes automatically to 550 naira. If you change this, for example, to the best case, it automatically reads 650 naira. These inputs affects the results of the company. For example, under the DCF valuation tab, you could see that the fair value per share of the company under the best case scenario is 78 naira 84 kobo, as you can see here. Now, if you change the assumptions to a base case or a worst case scenario, you could see that the valuation of the company automatically changes from 78 naira to 4 naira 14 kobo. This tells you that this company is highly sensitive to the input variables, especially pricing and other variables that have been predefined for this financial model. Number 3, it shows forecasts. Financial models are always looking into the future. So if you look at the financial model we just described, in the balance sheet, you can see the actual figure in blue for 2019 actual. You can see 2020 through to 2024 as estimate. So it should forecast into the near future. And then finally, it contains scenarios, that's hypothetical outcomes and sensitivity analysis. What would happen, for example, if interest rate goes up? How much can we discount before we start making a loss? All of this describe what a good financial model is, and it differentiates you from a spreadsheet. We've demonstrated that in the financial model for OJ Limited. OJ Limited, as you can see. And it's important that you know these differences between a good financial model and a spreadsheet as we move forward. That is the end of section 1. In section 2, we're going to talk about briefly the different types of financial model.